Welcome to a new era of personalized investing, where private investors understand that true value lies beyond mere relative performance. Amity recognizes that investing is a deeply personal journey, and success is not just about numbers. Discover a refreshing approach to investing that prioritizes clients' goals and well-being. Unlike ordinary investment options, we are dedicated to a true outcomes-based strategy, bringing certainty to investment outcomes. Don't settle for the ordinary. Embrace the future of predictability and certainty with our outcomes-based investment approach. At Amity, we believe in delivering personalized solutions crafted specifically for advisors' clients, understanding their risk appetite, goals, and preferences. Join us now and unlock the potential of a more rewarding and fulfilling investment experience that goes beyond the mere performance and places the client and their aspirations at the center of everything we do. Reduce uncertainty with outcomes-based investing. Amity Investment Solutions.
Good day everyone, and welcome back to part 2 of our 4-part webinar series on hedge funds. We believe that today's guest speaker will be truly exceptional. It is such a privilege to have Elmien all the way from Cape Town in our studios and for me to meet her in person. Elmien Wagenaar is the founder of Think Capital, and I wouldn't take much of your time today as she is sure to share with you a lot of information and valuable insights. Thank you so much, Elmien, for participating, and we look forward to hearing what you have to say about hedge funds.
Hi everyone, I'm Elmien Wagenaar from Think Capital, and I've been analyzing and investing in hedge funds for more than 22 years. And I am a firm believer that the right combination of hedge funds can play a pivotal role in the portfolios of a wide range of clients. But I've also named this session an important bird's eye view of South African hedge funds and allocators' perspective on opportunities and pitfalls. And the reason for that is that I also believe that to unlock the value of hedge funds for your clients, it is important to invest in the right ones. And the right ones may be different for different clients. And in order for me to assist you in doing that, I think it is important for you as the advisor to have a well-anchored understanding of the entire opportunity set of South African hedge funds before you get stuck into the fine details of a specific fund. So in order for me to do that, I'm firstly giving you a big picture, and I hope that that will assist you in being able to question and discern for yourself when a single hedge fund manager comes to present their fund to you. And hopefully it will also help you to build portfolios that has the highest probability of not disappointing. So let us just jump right in. So I think the first question that we need to ask is, why should we be thinking about hedge funds right now? And I think the answer is because we may be navigating new realities. So BlackRock, one of the biggest US institutional fund manager, is of the firm belief that we are in a new regime. Over the past 30 years, countries have benefited from cheap imports from China, and that has had a deflationary impact all across the world. And it helped the central banks to have a very light touch on interest rates. But there is now a new regime where both geopolitical risk and aging populations is causing supply constraints to dominate. And that is much harder for central banks to navigate with interest rates. So we have an environment where interest rates might be higher for longer, inflation might be higher for longer, or that it might not just be a straight line down for a period of 30 years as we've become accustomed to. So what will that mean for portfolios and for the world itself? Higher macro volatility, greater market volatility, and that for your investment strategy, a static approach to broad asset classes might be missing out of performance, and markets may move sideways for more often for longer despite higher volatility. And the interesting graph that they have constructed shows the greater divergence in US equity markets. And what this slide shows, or this graph shows, is the return of different shares in the Russell 1000 stock index and how far it moved away from the index. And then they created an average of all of those distances away from the index. So it shows that since 2009 to 2020, more or less, the average dispersion was 25%, and post-COVID, the dispersion has increased to an average of 35%. And what that means is that there's more investment opportunities, but you need to be more specific in how you navigate that. And I'm of the firm belief that hedge funds is actually one of the best ways of navigating a market like that. And the reason for it, I think, is that equity long shorts, in its purest form, is a dispersion trade. So it is meant to be able to capitalize on share prices diverging while not being reliant on the general direction of the market. And both these points are the points that BlackRock raise as characteristics of the market going forward. So share prices will diverge more from each other, so different sectors or maybe specific companies may move away from each other in terms of return, and the market might be more volatile or just move sideways for a long time. And therefore, a hedge fund is well positioned to do that. But in order for me to show that to you, we need to go into a little bit of mathematics. And I'm really sorry for those who hate maths. I promise you, there's also, in like 2 or 3 slides from now, there will be a picture that shows very much the same for your brain profile. But just hang in there and stick with us, please. So just as an example, say we have 2 managers that have a view that ABSA will outperform Capitec. So there's a dispersion between ABSA and Capitec. So let us just assume that the share price of ABSA is reliant on ABSA-specific information, or whatever the direction of the ABSA team that they are taking the company, plus some kind of sensitivity to the JSE. The same for Capitec. There's a Capitec-specific return that is captured in the share price, as well as a sensitivity to the JSE. And if you go short a share, short Capitec for instance, everything is reversed. So we will have a minus whatever the value of the share price is. So that comes to minus Capitec specific minus a sensitivity to the JSE. So with this in mind, let us think about how will a long-only portfolio take advantage of that view. So in a world where there was no constraints, that long-only manager will have a 100% long position in ABSA. And the return of that view would be reliant on the special return of ABSA plus a sensitivity to the JSE, so whatever the JSE does. If a hedge fund manager had exactly the same view, they could invest 100% long in ABSA and 100% short in Capitec. And that will result in a little mathematical formula, but what that is just derived from what I showed there under the definitions at the top. But the important thing that happens here is that because you are long and short, you are cancelling out the sensitivity to the equity market. And you are left with the ABSA-specific return minus the Capitec-specific return. So that's the purest way of really accessing the view that Absa and Capitec is going to diverge. You can also see that the return stream of the two approaches is very different. For the long-only manager to be successful, Absa specific needs to do, or the JSE needs to go up, or if the JSE is falling, Absa specific needs to outperform the JSE. So it is possible for the long manager to have a positive return from that trade, but it is much harder because he needs to navigate the returns of the JSE. But the hedge fund manager has substituted the sensitivity to the equity market with a share-specific view in Capitec. It doesn't mean that the hedge fund portfolio is without risk. There is still a risk that the trade can go wrong. In other words, Absa can fall and Capitec can rise. But the sensitivity is not to, the risk is not that of the share market. And just to show you how powerful that positive dispersion trade can be, is that is to look at when it makes money. So say Absa Absa specific increases by 5% and Capitec falls by 2%. The return of that trade is 7%. So that's obviously the best case scenario, where the one that you think is going to go up goes up, and the one that you think is going to fall falls. But this trade will also make money if both share prices are positive, but Absa just outperforms Capitec. So there's still a return of 3% in that trade if there's a dispersion. Remember, so dispersion is really just that the one is going to run away from the other, and that is what we need to capture. And then thirdly, and something that most people forget, is that the positive dispersion trade can also make money when the share prices fall. But again, Absa must just then fall less than Capitec. And all of this happens outside of the realm of what happens to the JSE. What is also important here is to think about the exposure that the hedge fund portfolio has. So even though it doesn't have a market exposure, it does have an exposure to two views, the Absa view and the Capitec view. And therefore, we would say that in this case, the 100% long Absa and 100% short Capitec has a 200% gross exposure. So that means that a view that twice the amount of capital is allocated in this trade, but it does not mean that it is reliant on the equity market to make money. The second reason why it truly makes sense for a hedge fund to navigate through this new regime is that there's a wide opportunity set in selection of securities. Shorting in itself opens up another view for the manager that has done exactly the same quantitative and qualitative work on a share price than any long-only manager. It just has a wider opportunity set. And then lastly, and also important for a volatile environment, is that the hedge fund can be used to protect from potential market downturns and adverse events. And for those that are not mathematically inclined and love the picture, here is the promised alternative. This is the actual look through equity long and equity short positions of the Think Capital hedge fund. That is a fund of funds that combines different managers. And you would see that the combination of managers had long views from which the portfolio can benefit, but also had short views from which the portfolio can benefit. And if you can also see that there are short indices in that portfolio. So if the FTSE top 40, so the South African market falls, then the first two positions will make money. The same with Euro Stocks, MSCI World, and then Woolworths, Tiger Brands, and the rest. So for those that didn't like the maths, you would see that there's an Absa long position and a Capitec short position. And cumulatively, if you look at the right, the net exposure, and that is all the longs minus the shorts, and that's the sensitivity to equity market of this portfolio, is below 40%. But the gross exposure, which is the longs plus the shorts, is 108. So it means that this portfolio is exposed to 108% of views of the manager. But it doesn't mean that it is more risky than a long-only portfolio, because remember, we've substituted a lot of the beta exposure with stock-specific exposure. So gross exposure is a measure of risk of a hedge fund, and net exposure as well, but it's not the only ones. So just to recap what this slide means is that returns resulting from the sensitivity to the direction of markets are replaced with company-specific exposures both on the long and the short side. And this is significantly different return stream that captures additional opportunities, especially when markets are down. So this portfolio or this strategy can be used as a complement to your client's long-only portfolio. Because it brings another source of return, and especially in the times when your long-only portfolio is may struggle because of its sensitivity to equity markets, this portfolio can come to the fore. And then lastly, the reason why hedge funds in this environment can really add value is that we don't only have equity long-short hedge funds in South Africa, we also have fixed income hedge funds in South Africa, and these ones can go long and short fixed interest instruments, and therefore benefit from interest rates going up or down, or even just the expectation of interest rates going up and down. But I'm not going to go into any more detail in this due to time constraints. So let us now jump into the South African hedge fund opportunity set and possible pitfalls. I can assure you that all the theory is now behind us. Now we just real life exposure to hedge funds. So if we look at the last 5 years, and we start off with South African bonds, or the bond index, and the JSE, you will see the risk and return characteristics of both those asset classes on the screen. If we then add all the ASISA general equity unit trust funds to the picture, this is what we see. A bit of a clustered exposure of risk and return around the JSE, but also the fact that a lot of the unit trust funds underperformed the JSE, but we understand that is typical in an environment of high resource exposure, and you guys are very well familiar with the reasons for that. If we then just add the multi-asset high equity unit trust to that as a frame of reference, those funds generated returns over the last 5 years very much in line with equities, but obviously with a more diversified scope. And definitely at a lower volatility. And again, these ones are clustered together around a certain value. And then if we add the South African hedge funds to the picture over the last 5 years, so these are all the South African single managers that had a track record 5 years, from 5 years to today, or to the end of June. And you will see that it is not clustered, firstly. It is spread literally from 2% up to 35%. So there is very little clustering around by the use of hedge funds. But then you would see that there was an opportunity to have lower volatility and similar returns. And that we know is the holy grail for for sequence of return risk for clients that need to draw from a portfolio. So the right combination of hedge funds could have helped you with that. Then there's also there was ample opportunity to outperform equities. And I need to stress that when I say that mention the outperformance of equities by hedge funds, I am not referring to the dots that are around 15% volatility and to the right of that. I am focusing on those left of the 15% volatility. So those that at moderate volatility outperformed equities. The reason why I say that is that the higher the volatility of a hedge fund, the higher the possibility of it underperforming over the next 5 years or the next period, because the rotation in hedge funds is much more pronounced than what it is in long-only space. But there was an opportunity to outperform equities, and the lower volatility would just have been a coincidental bonus to those clients who can actually handle volatility. The point is that the fact that you can handle volatility in your portfolio doesn't mean that you have to endure volatility without, while there is an alternative that could have generated a higher return for you in combination with the positions that you already have. And then lastly, what I need to point your attention to is to that row of hedge funds that performed more or less in line with the best multi-asset high equity funds and at the same volatility. So that little green line at the top of the orange. So many of you would say that, but why would it have added value to pay the hedge fund manager excess fees to make them rich, and they generated exactly the same return as the balanced fund that I was invested in? I would challenge you on that by saying that the fact that you did not give up any returns for an additional source of return must create awareness or create excitement for you, because it means that you can include this alternative source of return with your balanced fund, and for the next 5 years you might have, instead of 3 drivers of performance, you will have 4. And that is a more robust portfolio with a higher probability of sustaining the returns that it had over the last 5 years. The second pitfall that I would like to get across is that a specific hedge fund strategy does not represent a specific risk and return profile, and that is extremely important to know. And I'll show you what I mean. Again, we start off over the last 5 years, bonds and equities just as markers to return and risk. Then we look at the South African fixed income hedge funds. So immediately you would see that it seems to have 2 sets of fixed income hedge funds in South Africa. They're very conservative ones, and ones that are more volatile, and actually more volatile than bonds, and a little bit less, or at least less volatile than equities. But then when I add the equity market neutral funds, you will see that it is not true that the fixed income was less volatile than the market neutral ones, even though they, by definition, have very different positions. And then we add the equity long short hedge funds to the mix. And again, it does not say the fact that a fund is categorized or named a long short fund, that it is more risky than fixed income, and in many cases more risky than some of the market neutral funds, because each and every one has a very specific style and strategy and mandate, and we need to drill into that to understand the risk and return profile of each and every fund of those. I'm just adding the last large group of strategies, and that's the single manager multi-strat. So these are of funds managed by one specific hedge fund manager, but they can invest in different asset classes. Again, a wide range of volatility and a wide range of returns. And then there's just a few extras that has small categories. But the takeaway here is that a specific strategy does not represent a risk and return profile, and very specifically that fixed income hedge funds are not less risky than any others. And that point I want to get across, because the last thing that we want is that a conservative client with the expectation that a portfolio of fixed income hedge funds will create low risk and predictability would be the wrong assumption, and I want to guard against that. And I think to bring that point again to the fore is that if we look at the fixed income hedge funds over the last 5 years, again the two sets of risk profiles that I as an allocator am clear about, even if you drill down into the underlying strategies, it is clear because of what they do that their volatility will be different. And but the question that I would ask is that why would, over the last 5 years, would you have invested in the more aggressive ones if the less aggressive ones generated more or less the same return? But that is part of the questioning when you analyze a hedge fund. The important bit here is that I show that relative to all the other opportunities in hedge funds, and you could have generated good returns from your fixed income portfolio over the last 5 years. But when we look at the last 3 years, the picture has significantly changed. So you still have the fixed income hedge funds that span really from very low volatility to the volatility of equities over the last 3 years. More risky than bonds, lower return than bonds. But then the opportunity set outside of fixed income is then given in the next slide. So this means, firstly, that all the returns, or a majority of the returns in fixed income hedge funds, were generated in the first 2 years of the last 5 years. And that was when the COVID crash happened and interest rates were reduced very rapidly. I'm showing this to bring the point across that it could be that that certain set of hedge funds have exposure to the same risk factors. And I show the example for fixed income, but it could be true for equity funds as well. So I'm not picking on fixed income. But I also want to give you the takeaway that the rotation within hedge funds can be much more pronounced. So in order for the client to have generated the return on the right, they had to have been invested in that fixed income fund or those fixed income funds 5 years ago for the first 2 years, and then actually should have shifted subtly to some of the other strategies, or from the start had a more diversified approach. So once we've covered the single strategies, so how is it that different hedge funds can generate different outcomes, or is it so that there are vastly different outcomes created by hedge funds? And what I show you here is the Alexander Forbes Large Manager Watch for Hedge Fund of Funds, and all the funds that submit data to that survey. And it's all fund of hedge funds. In other words, they represent a combination of South African hedge funds chosen by those teams. And it does seem that there's a bit of an efficient frontier in combining hedge funds. So you could have generated a lower volatility portfolio or created a lower volatility portfolio, which would have generated a good but lower return. And then as you move to the right, assume more volatility, that over the last 3 years, more returns were generated. And then it does seem that the Think Capital Growth Fund is defying the risk and return characteristics of the universe. And as an allocator, or if you as the advisor want to understand the characteristics of that, the way in which I would analyze that is the following. So I look, maybe just quickly go back. What I've selected is the Alexander Forbes Stable Fund, which is to the left of the graph. So the most conservative, or the very conservative fund from one of the biggest allocators to hedge funds, Alexander Forbes. And then I've also looked at the Alexander Forbes Focused Fund, which is the more aggressive combination of hedge funds of Alexander Forbes, as well as the Think Capital Growth Fund, to see then, to analyze why these returns are so different. And the graph that you are seeing on the top left hand is a bit of a regression graph. So it shows that every block that you see there is the return of the fund relative to the JSE in 1 month. In other words, every single block represents a month, and then you can read off what the return of the fund was and what the return of the JSE was in that month. And I think it is fairly clear that no matter where you are on the JSE scale, so positive or negative, this fund generally generated positive returns. So I think that is if many people, there's two views of hedge funds. The one is that it must be positive all of the time, or the other wacky idea is that it is extremely volatile or extremely risky. But this is the bog standard profile of a low risk combination of hedge funds that generate returns, the positive return all of the time or most of the time. If we then move, and the outcome of that was a 98% cumulative return, and that is it's over the last 9 years. So since November 2014, and that is the time period the longest time period that all the funds had a track record. So if you then move to the top right-hand graph, you would immediately see that there's a higher sensitivity to the JSE. It doesn't mean that it's not that if the JSE is up 10%, the fund is up 10%, or if the JSE is down 10%, the fund is down 10%. So there's definitely hedging happening. There's a lower sensitivity to the JSE. It's not 100% sensitivity, but there's a definite sensitivity. And that approach, so that is by selecting a different set of South African hedge funds to create that profile. And the cumulative result of that is a 92% return versus the 103 cumulative over the period. And then to the bottom left, you have the Think Capital Fund that generated a lower volatility, remember, with a high return. And there you can see that the sensitivity to the JSE seems to be lower than that of the aggressive Alexander Forbes Fund. But then a little bit higher than that of the conservative fund, but that when the fund is positive, there were ample months where it generated positive returns when the JSE was down, and ample months when it generated positive returns when the JSE was up. So the cumulative effect of that, just sufficient protection, sufficient generating of returns when the JSE is down, but not all of the time, and sufficient participation when equities are up, generated a cumulative return of 122%, so a strong outperformance of the JSE over the whole period. And really just to frame that in the risk and return space, it's an outperformance of the JSE for the Think Fund, but then very comparable returns for the other funds, lower volatility than bonds for all three of these combinations of hedge funds, and I think of all of them valuable additions to a long-only portfolio. Just to drill into the combination of hedge funds that generated higher returns without the sensitivity to equity markets as a combination of hedge funds, because a lot of people would say, yeah, that's great, but a fund of funds, you will just get average returns. So that's what we test in this graph. And what I show are all the single strategy funds that underperformed the Think Capital fund over the last 5 years, and then all the single strategy funds that outperformed the combination of hedge funds after all fees. So the takeaway here is that a combination of hedge funds where there is subtle but intentional rebalancing from one fund to the other, or one strategy to the other, can actually generate significant returns versus a buy and hold strategy of whatever combination you would have put together at the beginning of a 5-year period. So active management of a hedge fund, of a combination of hedge funds, is actually a very valuable asset to most portfolios, in my mind. So really just to draw it all together, for where do we use a combination of hedge funds? So I've again used the Think Capital fund, so generating a return higher than bonds and equities at lower volatility. So it is for that client that needs predictability. I always find it really sad if the fact that we have drilled into the minds of our clients that, yes, sure, the client cannot handle the volatility of equities, and that I think is a given. But then they believe that they have to have significantly lower returns from the rest of their portfolio in order to bring down that volatility, and that is just not true. The right combination of hedge funds can help that client to reduce volatility and sustain their capital for longer. And that's my passion, to get more people to understand that, and to make a real difference in the savings of clients. But then in the second graph, it's important to show that it is also for that client that wants growth, that can handle volatility. But I would argue that the fact that the client can handle volatility doesn't mean that they do not want to generate excess returns. And especially when the portfolio that is more exposed to volatility has drawdowns, those are the times that the combination of hedge funds will kick in, or should kick in, and generate ample returns. But it doesn't mean that you will give up all the returns then again when equity markets are up, because you do have exposure to the long side of equities, remember, from that example that I showed you. So I think for both predictability and growth, hedge funds can be considered. And it doesn't mean that you need to consider the most conservative of the most aggressive hedge funds for the aggressive client. It is actually toning it down, selecting a moderately volatile fund of funds or combination of hedge funds, and enjoying the compounding that brings, and the predictability that it brings to the more aggressive portfolio. So lastly, I think I want to ask the question, how can fund of hedge funds add value to your client's portfolio? And the first point is that no single fund covers the entire opportunity set, and a combination can create a more robust outcome without necessarily having to dilute returns. Because remember, we are taught that as soon as you want to diversify, you have to give up some returns from your highest returning asset. And that is purely just not true. The second point where fund of hedge funds can really add value is that different strategies perform better under different conditions, and those conditions can actually be quite long or can be prolonged. So subtle yet intentional and timely rebalancing can add significant value to your client's portfolio. And then lastly, it doesn't need to be a be-all and end-all. You don't need to choose between a hedge fund of funds and doing your own thing, because there's enough specialist fund of funds in our industry that can generate such a different and unique return and risk profile that it can easily be a complement to a portfolio that the advisor selects themselves of a few single strategy managers as part of a core satellite allocation strategy. And that is our story. I hope you found it invigorating, and that you will reach out for more information on hedge funds in general. Thank you.
Thank you to Think Capital for their participation in this webinar. Join us next week when Tumi Luate from 361 will be continuing the discussion on hedge funds.